Let's dive right into this explainer. Today, we're putting a true financial behemoth through the ultimate valuation gauntlet. As an investment analyst, I absolutely love taking real-world data and stress testing it. So, we're going to take the freshly released Q 2026 data for TD Bank and throw it up against the legendary, battle-hardened frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, and some modern quantitative models. If a stock can survive this gauntlet, well, it's a rare gem for sure. Let's get to it.
Here is our roadmap for the analysis. We've got a quick company snapshot, then the Buffett, Lynch, and Graham lenses, followed by DCF and other models, and finally our synthesis and recommendation.
Okay, Section 1, Company Snapshot. TD is not just a bank, it is a foundational piece of the North American economy operating at just massive scale. Looking at the raw numbers, TD Bank, trading under the ticker TD, boasts a market cap of $197 billion. And they just posted a really impressive 15% year-over-year bump in Canadian personal and commercial banking earnings, bringing their Q2 2026 adjusted EPS to $2.38, plus the rewarding shareholders with a solid 3.2% dividend yield. But, it's not all smooth sailing. They're currently navigating some heavy U.S. regulatory anti-money laundering challenges, which recently resulted in a massive $434 billion asset cap placed on their U.S. subsidiaries. So, great business, but definitely under a temporary regulatory cloud.
Moving on to Section 2, the Buffett lens.
So, the real question here is whether this massive operation has the underlying quality required by the Oracle of Omaha. As you probably know, Buffett is notoriously picky with financials. He's looking for a durable economic moat, super consistent earnings, manageable debt, and honest, highly competent management. He wants to calculate owner earnings and buy at a price that offers a distinct, undeniable margin of safety. Let's see exactly how TD stacks up against these really strict criteria.
First up is the moat. TD has a massive low-cost deposit moat across North America. And get this, their 2026 AI Insights report shows they're successfully using AI for routine tasks, like fraud protection and basic inquiries, while still preserving human advisors for complex stuff like retirement planning. That is a seriously strong technological moat. Their debt? Ultra safe. They're boasting a 14.3% Common Equity Tier 1 ratio. That's essentially a massive financial safety buffer and it's top of its peer group. However, Buffett would absolutely scrutinize the management oversight that led to the $500 million in AML remediation costs expected for 2026. Buffett hates unforced errors that erode shareholder trust, and that is exactly what this is.
Now check this out. At 14.4%, TD's adjusted return on equity is a remarkably strong profitability metric that firmly checks one of Buffett's biggest boxes. A bank generating over 14% on its equity while holding a top-tier capital buffer? That's exactly the kind of highly efficient capital compounder Buffett dreams about.
But here's the catch. Buffett doesn't just buy great businesses, he buys them at great prices. To estimate his target price, we calculate a baseline intrinsic value of roughly $121 based on their owner earnings power. But Buffett demands a strict 20% margin of safety on financials to protect against unforeseen risks, like, those AML penalties. Applying that discount gives us a required buy-in price of $97.31. With the stock currently sitting up at $119.30, Buffett would likely admire the business from afar and wait patiently for a market dip.
Let's switch gears to Section 3, the Lynch lens.
Let's build a totally different perspective using Peter Lynch's philosophy. Lynch famously categorizes companies into distinct buckets to understand their specific growth potential: fast growers, asset plays, turnarounds, and stalwarts. With its sheer size, that $97 billion market cap, and the steady dividend payout, TD Bank perfectly fits the profile of a stalwart. These are large, well-established companies that offer defensive protection during recessions but can still grind out moderate growth.
To find Peter Lynch's verdict, we got to rapidly weigh the pros and cons. On the plus side, an incredibly strong balance sheet and record domestic earnings. I mean, that 15% jump in Canadian personal and commercial banking is phenomenal. But on the flip side, we've got the harsh reality of capped U.S. growth due to the regulatory asset cap and an elevated price-to-earnings ratio of 15.9 times adjusted earnings. Remember, Lynch loves strong balance sheets and low institutional ownership, but he absolutely refuses to overpay for growth.
And that brings us directly to Lynch's favorite metric, the PEG ratio, which is just price to earnings divided by the growth rate. Making the explicit assumption that TD hits the midpoint of its stated 6 to 8% earnings growth target, let's just call it 7%, we divide the 15.9 PE by 7. That puts the PEG ratio at a pretty pricey 2.27. Since Peter Lynch strongly prefers PEG ratios much closer to 1,
This leads us to a Lynch-style verdict of hold. The price is simply growing faster than the earnings right now.
All right, Section 4, the Graham lens.
Now we're diving into the most mathematically rigorous framework of our entire gauntlet. Ben Graham wants massive safety, low valuation multiples, and literally zero speculation. He doesn't care about AI innovations or shiny future narratives. He only cares about cold, hard, present-day assets. So we are going to run TD's financials straight through his famous defensive investor checklist. Let's see if it survives.
So TD easily passes Graham's size test with its $197 billion market cap. It also crushes the strong financials and earnings stability tests, totally backed by that 14.3% CET1 ratio. However, Graham demands a PE under 15 and a price-to-book multiple strictly under 1.5. TD's current price of $119.30 pushes its PE to 15.9 and its price-to-book to 1.74. So it actually fails the valuation tests. It's just outside of Graham's ultra-conservative safety limits.
But we can take it a step further. We can calculate Graham's exact intrinsic value using his famous formula, kind of the true holy grail for value investors. It's the square root of 22.5 multiplied by trailing EPS multiplied by book value per share. Using TD's annualized EPS of $9.64 and its current book value per share of $68.22, we can literally just run the math.
And this beautiful formula spits out an intrinsic value of exactly $121.64. Technically, yes, this is slightly higher than the current $119.30 stock price. But remember, Graham requires a massive margin of safety, usually 30% or more. He would never, ever touch an asset trading this close to its intrinsic value limit. So that makes this a very hard hold for the father of value investing.
Section 5, DCF and other models.
Let's step out of the history books for a minute and look at how modern Wall Street analysts value the stock. Because traditional free cash flow is super tricky to calculate for banks, mainly since debt is essentially their raw material, we have to make some explicit structural assumptions. First, we'll use a proxy for cash flows, which is dividends paid plus retained earnings. Next, we calculate a terminal value, assuming a highly conservative 2% perpetual growth rate. Finally, we discount those future cash flows back to today using a 9% weighted average cost of capital, or WACC. This perfectly accounts for the current interest rate environment and those lingering regulatory risks we talked about.
Running the data through a sensitivity table is great because it shows how valuation shifts based on your assumptions. If we look directly at our base case assumptions, that 9% WACC and a 2% terminal growth rate, the quantitative DCF model values TD Bank at exactly $110 per share. To make sure we're on the right track, we need to corroborate our DCF by applying a secondary model. So, we ran a dividend discount model, or DDM, using TD's very safe $4.48 annualized dividend, and we assumed a 5% historical dividend growth rate. The DDM returned a fair value of $112. What's absolutely fascinating here is that these models, 110 from the DCF and 112 from the DDM, they perfectly align with the current Wall Street consensus median price target, which is $111.40. The modern math is highly unified on this one.
And finally, Section 6, Final Synthesis and Recommendation.
We've run all the data through the gauntlet, so let's bring these distinct valuation lenses together into one cohesive verdict. Buffett's target is $97, Lynch balks at the high PEG ratio, Graham's absolute ceiling is around $121, and modern quant models place fair value right around $111. So, despite TE's stellar 14.3% CET1 ratio, its really impressive AI integration, and those record domestic earnings, the current price of $119.30 offers zero margin of safety. Zero! Therefore, the synthesized, completely data-driven recommendation is to hold the stock until a much better entry price presents itself.
As we wrap up this explainer, I want to leave you with a final thought to consider. TD Bank is an undeniably fantastic, highly profitable business that's currently just navigating a temporary AML storm. But in the strict, disciplined world of value investing, patience is the ultimate virtue. If a world-class franchise is priced for perfection, is the true risk in the company itself or in the price you pay? Think about it. Thanks for tuning in, and I'll catch you next time.